Okay, so let's start off with firstly, what is auditing? Now remember guys, accounting is the preparation of financial information. Auditing is the checking of financial information. So auditing involves the verifying is the checking of financial information presented in the financial records of a business. Every public company in terms of the Companies Act, so every public company in terms of law must be audited by an external auditor. So we're going to look at what's an external auditor, or we're going to revise on external auditor in a moment. The audit is done in accordance with Companies Act as well as in accordance with IFRS. Now, this is something that you already are aware of. Okay, so let's now look at what is the difference between an internal auditor and an external auditor. Now, starting with an internal auditor, immediately an internal auditor, guys, works for the business. The internal auditor has his office, he works for the business on a daily basis. The audit department, the internal audit department. So what is the internal auditor responsible for? They are responsible for establishing and continuously monitoring the effectiveness of internal controls in a business enterprise. So they draw up the internal control procedures, they ensure that it's implemented, they monitor whether or not it's effective, whether it's working or it's not working, and so on. The internal auditor usually carries out an internal audit based on obviously the internal controls that are in place on a continuous basis. He or she is employed by the business, as I mentioned earlier on, and reports to the directors. So that is very, very important. The internal auditor reports to the directors. Okay, let's now recap on who then is an external auditor. So immediately, external auditor, he or she is obviously coming from outside. He's got nothing to do with the business, but comes into the business to check the financial statements and express an opinion on the financial statements, on the presentation of the financial statements. So the external auditor is responsible for expressing an opinion in the audit report on the financial statements of the business, and this happens at the end of the financial year. Okay. In order to express an opinion, it is necessary for the external auditor to carry out what we call an external audit. And once again, audit, the checking, the verifying of financial information. So the team of external auditors will come into the business normally at the end of the financial year, and they will then audit the information that is presented in the financial statements. Right, the next point is very, very important. Remember, it is not possible for an external auditor to audit everything. Right, an external auditor, guys, charges by the hours spent at the business. So it is impossible for them to audit absolutely everything. It will take forever. He or she only audits a sample of transaction based on materiality, how important a specific item is on the financial statements. So please remember this. He will base his opinion on a sample. An external auditor reports to shareholders. Now again, very, very important. The internal auditor reports to directors, whereas the external auditor reports to shareholders. So when they present their audit report, it is addressed to the shareholders. Right, they rely on the audit report. Who do we mean by they? the shareholders rely on the audit report when making important decisions about investment in the business. Now remember, a company could have close to 1,000 shareholders. Not all shareholders will be involved in the day-to-day running of the business. They will appoint directors. So they might appoint, let's say, 7 directors to run the business. These shareholders rely on the external auditor to come into the business, audit the financial statements, and present their audit report. And based on that audit report, the shareholders then decide whether or not to continue investing in this particular company, whether or not to sell their shares, and so on. Okay. An external auditor must be independent or seen to be independent. In other words, an external auditor, remember, is coming from the outside. He's got nothing to do with the business. Why does he have to be independent? Because if he's independent, then he can present an unbiased opinion on the financial statements. But the moment he has some kind of dealings with the business, he owns shares in the business, or his wife is the CFO of the business, then his independence is compromised. And remember, in that case, you might not be able to give an unbiased opinion on something. Okay, right. And then finally, please remember the objective of an external audit is not to detect fraud. An external audit is conducted in order to express an opinion on the financial statements. Okay. Right, guys, now obviously again, I'm reminding you this is a revision. This is something you've done in class, but it's something that you should take note of. It always appears in the exams, difference between an internal auditor and an external auditor. Please make sure that you learn this. Make sure that you know this. Okay, right, let's now move on. Something else that is commonly tested in your exam are audit reports. So we've touched on audit reports already. An external auditor expresses an opinion in an audit report. So in other words, the summary of his findings will be in an audit report. Now remember, an audit report forms part of an annual report of a company, right? So when we talk about an audit report, there are 3 types of audit reports that could be given to a company. So let's quickly recap on audit reports and these types of audit reports, the difference between the 3. An audit report is a component of an annual report. So I mentioned that already. Remember, your annual report is made up of your income statement or statement of comprehensive income, your balance sheet, statement of financial position, your cash flow statement, director's report, and the auditor's report. So this makes up your annual report. Right, it's drawn up by the auditor after he completed the audit. I mentioned that already. He or she will express an opinion in the audit report, and the audit report, very important, is addressed to shareholders. Okay, so your 3 types of audit reports. The first type is what we call an unqualified report. Now remember, guys, an unqualified report is when the auditor has not identified any concerns that needs to be presented to the shareholders. In other words, the auditor is basically giving you a thumbs up. Everything is absolutely A-OK in this business. So an unqualified report, the auditor has not identified any concerns relating to the fair presentation of the financial statements. Okay, right, so I'm going to put a smiley face. That's what I normally do. Right? So in other words, unqualified report is an absolutely brilliant audit report to be given to a company. Then the next report is a qualified report. Now a qualified report, the auditor, everything is okay except for. In other words, the auditor has identified a concern that he wants to make the shareholders aware of. So, for example, assets could be overvalued, or there could be some kind of concern that he's picked up, and now he's informing the shareholders about his findings. So, a qualified report, the auditor has identified a concern relating to the fair presentation of the financial statements. He then makes the shareholders aware of this in his audit report. Okay, so here I'm going to put a face where, okay, there's no smile, right? He's not happy, nor is he unhappy. Everything else is fine except for a concern that we have identified. And then finally, the last type of audit report, the worst possible audit report, is a disclaimer. So here, a disclaimer basically means that the auditor is of the opinion that the financial statements are not reliable and he does not express an opinion. This has severe consequences for the company and the directors. So in other words, this is the worst possible audit report to receive, and as a shareholder you will be very, very concerned if there's a disclaimer of opinion where the auditor refuses to give an opinion on the financial statements. It means things are really bad and really serious. Okay. Right, so how will this be tested in your exam? So remember, you will be given an audit report, and normally you will be asked to identify the type of audit report. So some of the key words that you need to look for. Right, so we're going to do a question in a bit, but let's just go through the key words. Fairly presents in all material aspects in accordance with IFRS and the Companies Act. So if the opinion paragraph says fairly presents in all material aspects, everything was done in accordance with IFRS and the Companies Act, it means this is an unqualified report. Okay, there's nothing for us to disclose, everything is okay. Right, then, if the audit opinion tells you fairly presents except for, and this is key. So the moment you see except for, this is an indication that it is a qualified report. Okay. And then finally, disclaimer of opinion. How do we know if it's a disclaimer of opinion? We are going to look for the words "we were not able to obtain sufficient evidence," "we do not express an opinion." So the moment you see these words in the opinion paragraph of the audit report, you know, hang on, this is definitely a disclaimer audit report. Okay. Right, so we've touched on auditing. Let's now get into an exam type question. Right, we are given an extract of an audit report. We have audited the annual financial statements of HTH Limited for the year ended 31st December 2012. Auditor's responsibility. Our responsibility is to express an opinion on the financial statements based on our audit. We conducted our audit in accordance with IFRS, or International Standards on Auditing. These standards require that we comply with ethical requirements and plan and perform the audit to obtain reasonable assurance whether the combined and consolidated financial statements are free from material misstatements. Okay, so they're giving us the auditor's responsibility extract. Then the opinion extract. In our opinion, the financial statements fairly presents, in all material respects, the financial position of HTH Limited as at 31st of December 2012 and its financial performance and its cash flow for the year then ended in accordance with IFRS and in the manner required by the Companies Act of South Africa, and then obviously your auditor signs the audit report. Okay, right, so we've read through the audit report very quickly. Now let's look at the information or the questions, and we'll go back to the information. So the very first question, is the auditor's report that's given a qualified or an unqualified report, and they want you to substantiate? Okay. Right, so remember what I said earlier on. You've got to look for key words. So here's my opinion paragraph. And in this paragraph, they're telling me the financial statements fairly presents in all material respects, right, in accordance with IFRS and the Companies Act. So immediately looking at these key words, it is obviously an unqualified report. Right, and how do I know it is an unqualified report? Because fairly presents, so I'm going to actually quote that in my answer, and in accordance with IFRS and the Companies Act. Okay, so report, it's an unqualified report. Okay, and remember, you are substantiating by actually quoting that the audit opinion states that everything fairly presents. Okay, so you're actually quoting this and you're mentioning everything was in accordance with IFRS and the Companies Act. Okay, so you're giving a reason as to why it is a qualified and unqualified report. Remember, if it was a qualified report, you're then looking for the words except for, but we haven't found that in this opinion paragraph. Right, then the second question, explain the significance of the word independent in the title of the auditor's report. So why is it called an independent auditor's report? So exactly what I mentioned earlier on as I was recapping on auditors and recapping on the internal and the external auditor. So remember, independent is a sign that this is an external auditor and he does not work for the company. So independent, he's coming from the outside, he doesn't have any attachments to the company as such, he will be free from any sort of, he will provide an unbiased opinion on the financial statement. So he's independent. Right. And remember, it is essential that the external auditor be free to express an unbiased opinion that is not influenced by others. That's what's just missed out here, guys. So that is not influenced by others. Okay, he must be independent. Remember, if his wife is working for the company, if his wife is one of the directors, then that independence will be compromised. Okay. Then also because independence gives credibility to his report and it enables others to rely on the report. So the moment you know it's an external auditor, he is independent from the company, you know, I can rely on this report. He's coming from the outside, he's not going to have any bias against the company, it's going to be an unbiased opinion. Okay, right, then the next question. Why does the Companies Act make it a requirement for public companies to be audited? So remember, the Companies Act is obviously law. It's a set of law that the companies need to abide by. And one of the requirements is that the financial statements must be audited by an external auditor. So why is this a requirement? It is a requirement because remember, you've got thousands of people, shareholders that are investing in the company and they do not deal with the daily running of the business itself. So their investment needs to be protected. They need to have someone from the outside coming into the business and checking the financial statements. Okay, so that is why it is law, it is a requirement by the Companies Act. It's basically to protect the shareholders. Okay, right, so if you look, I've written out the answer already. To protect the shareholders as a result of separation of ownership and management. Remember, the shareholders own the company, but the directors obviously manage the day-to-day running of the company. Yes, directors are shareholders, but remember, directors are appointed by shareholders to run the company. So it's to ensure that your shareholders, all your shareholders, are protected. Right, the shareholders of a company need to have confidence in the company's ability to look after their investment. Public funds are being used, exactly what I mentioned earlier on, to ensure that it is a fair reflection of the financial statements. So again, remember that your financial statements are audited, they are checked, and this will ensure that it's a fair reflection of the financial statements, because if it was not fair, that would be mentioned in the audit report. To ensure that directors are not misrepresenting the figures, to be accountable to stakeholders, for example, shareholders as well as SARS, to ensure that the correct tax is being paid to SARS. And then finally, you could mention to discourage fraud. Okay, right, let's move on now to the next question. I'm just looking at time. We still have a bit of time left, so we can move on to question 4. Although this audit opinion is addressed to the shareholders, other interested persons will also want to read it. Identify 2 other people or parties that would be interested in the audit opinion and give a reason for his or her or their interest in the opinion. Right, now normally there's a misconception that only shareholders are interested in the audit report. Remember, not only shareholders will read the audit report. There are various other parties, other stakeholders that are also very interested in the company's financial statements, in the company's audit report. So who are these other parties that could be interested? Right, firstly, your prospective shareholders, your future investors, right? So investors who are thinking about investing in this company, they will rely on the audit report. They will look through the audit report to see whether or not their investment is safe, whether or not their financial decision is a correct decision to make. So your future shareholders, people that are thinking about investing in the company. Then your lenders, for example, your banks, your creditors, they are also interested in the financial statements, and they want to ensure that the financial statements fairly present the financial position of the company before they give you a loan. So remember, if the bank is going to grant you a loan, they will want to first look at your financial statements, right? And obviously, if the financial statements are audited, it gives those financial statements some kind of credibility. I can rely on these financial statements. Same with your creditors, your suppliers. If you are buying on credit, again, they want to ensure that they're going to receive their money, they're going to receive their payment. So they will want to look at your financial statements. Right, so I've explained lenders, I've explained suppliers. Right, another party very interested in your financial statements is SARS. Okay, the tax man. Why is SARS interested in your financial statements? Obviously, because of tax. Remember, if your income statement is incorrect, it means that you are paying the incorrect income tax to SARS. So they want to ensure that they're getting a share of your profits, they're getting the correct share of profits. Right, then competitors. Remember, even competitors will look at your financial statements because they want to compare financial results. So you could get 2 businesses that are selling the same or similar products, and they will want to compare financial statements because they are comparing results. Right, then trade unions, and this is normally for wage negotiations, the employees to ensure that there's job security. Remember, at this time in our lives, obviously because of the pandemic, many of our listed companies, our public companies didn't do as well as they normally would have because of lockdown, because of having less customers in their shop. And normally your employees will look at the financial statements. Do I still have a job? Okay, is my company still making enough profits to keep me employed? Okay, right, and then board of directors, your CFO, here normally to assess performance, their performance as they managed the business. Okay, so they're interested in looking at the financial statements to see whether or not they were able to correctly manage the business in terms of making that profit or handling their assets and so on. Okay, right, question 4 done and dusted. Let's now move on to the next question, question 5. At the annual general meeting, one of the shareholders stated that he is not happy with the word fairly present in the audit report. He wants the auditors to say that the financial statements are correct in all respects. Explain one point to the shareholder as to why the auditor cannot make the statement. Okay, now if we go back to the audit report, right, remember, in the audit report, the auditor will say whether or not the financial statements fairly presents the financial position of the business. He does not give complete assurance that everything is 100% correct. He uses the word fairly presents. Now remember, an auditor will base his audit opinion on a sample of transactions that are material. Material meaning that it is so important that if it's left off, it affects let me just say that again. So materiality, something that is of very high importance, that if it's left off the financial statement or if it is included, it could affect a shareholder's decision in terms of his investment. Right, so fairly presents. He doesn't give complete assurance because he doesn't audit every single transaction. So he cannot, right, let's go back to the question. He cannot mention that it is correct in all respects. He uses the word fairly presents. And the reason for that is he audits only a sample of transactions. He cannot audit all the transactions. It is not possible. Okay, so guys, please remember that. An auditor will only audit a sample of transactions. Right, let's move on. We've got about 4 minutes left, and I think I've got 2 questions to go, so we should have enough time to finish. Right, question 6. The directors are not happy with the high audit fees reflected in the income statement. So remember, the auditor, obviously, he's not going to conduct the audit for free. He's going to charge the business for the time spent conducting the audit. So you've got directors that are not happy with the high audit fees. Explain one reason why improvement in internal control will have a positive effect on the external auditor's fees. Right, now remember earlier on we spoke about the internal auditor. The job of an internal auditor is to obviously design suitable internal controls for the business, right? Whether it's protecting the assets, whether it's protecting cash, whether there's control over debtors and so on. The internal auditor will design internal control procedures. Right, those internal control procedures, if they are effective, in other words, if they work, right, they're doing what they're supposed to be doing. When the external auditor comes in, he ends up spending less time in the business because there's already measures in place that is protecting the business. okay, or protecting the assets of the business. So the external auditor then does not spend that amount of time. He spends less time, and because he spends less time, then your audit fees will then be lower, because remember, an external auditor charges by the hour. So if he spends less time, obviously then you are paying less audit fees. So the key is you need to have effective internal controls in the business. Okay, right, so exactly what I've explained there. More effective internal controls will result in better systems and procedures that are in place, and therefore less time will then be spent by the external auditor. Okay. Right, we're down to 2 minutes and we've got one more question to go. So let's look at our final question, question 7. Explain one reason why it is important that the audit is done in accordance with IFRS. Right, now remember guys, the audit is conducted according to, or is done in accordance with the Companies Act, the requirements of the Companies Act, as well as international financial reporting standards. Now, why do we have to apply international standards when conducting the audit? The reason for that is we live in a global village, right? What do I mean by global village? We could have our head office in South Africa, and we could have other offices in London, in Japan, throughout the world. We live in this global village. Similarly, our shareholders could be from Africa, could be from Europe, and so on. So the reason why everything is done in accordance with IFRS, the audit itself, businesses operate on the world or global market either directly or indirectly. So therefore, financial statements must meet international standards. Foreign investors are important to the company and to any country. Holding and subsidiary companies may also be in other countries. Okay, so that is why it is done in accordance with international standards.